You have been lied to. For decades, the world has been told a simple fairy tale. Warren Buffett is a genius stock picker. They tell you to buy low, sell high, and hold forever. But this is the superficial lesson, the 1% of the iceberg visible above the water. If stock picking were the real secret, every finance graduate would be a billionaire. The disturbing truth is that the fundamental mechanism that built the majority of his $130 billion fortune is not available to 99% of the world's investors. The financial machine he built is powered by free money, controlled enterprises, and a psychological discipline forged in crisis. This is not a story about buying Coca-Cola. This is the deconstruction of the most powerful financial fortress ever built. The mystery isn't that he's rich. The mystery is how he maintains the greatest capital advantage in modern history. We're talking about an ecosystem of money generation that utterly breaks the laws of traditional investing. Over the next 10 minutes, we are going to expose the three core engines that transformed a value investor into an economic titan, secrets that finance textbooks deliberately overlook. First, we will reveal the shocking math behind his wealth, the statistical anomaly that proves mere skill is irrelevant. Second, we will break down his unique access to a limitless $147 billion interest-free loan that funds every major acquisition. And finally, we will look at his most powerful weapon, a psychological discipline that allows him to buy the entire world at the exact moment everyone else is paralyzed by fear. If you think you know the Buffett story, prepare to have your investment philosophy completely rewritten. Let's start with the one fact that refutes the genius stock picker narrative. His success is overwhelmingly a function of time, not just talent. Look at this data point, the one they rarely show you. Over 99% of Warren Buffett's net worth was accumulated after his 50th birthday, and 97% was accumulated after age 65. Buffett's annualized returns were often higher in his youth, but the dollar value accumulation was negligible compared to the recent decades. If he had retired at 60, like most successful executives, his legacy would be an asterisk in financial history. The real secret is the longevity and the sheer discipline to not interfere with the compounding process for over 70 years. This isn't just a lesson about patience, it's a lesson about scale. When you are compounding $100 million, a 20% return is $20 million. When you're compounding $500 billion, a mere 1% return is $5 billion. The game changes completely. The majority of his work in those early decades was simply surviving the inevitable crises and avoiding the mistakes that forced other brilliant investors to liquidate. He did not achieve the highest returns. He achieved the most durable returns. The exponential curve only rewards those who stay on the tracks through the steepest downturns. He built the foundation slowly, so the final ceiling could be reached explosively. But even longevity requires fuel. How does a man continue to buy billion-dollar companies without ever having to raise money or pay interest? The answer lies in the most brilliant and least understood element of his empire, the $147 billion interest-free loan. To understand the machine, you must understand Berkshire Hathaway's primary business, insurance. When you pay an insurance premium, that money is collected before any claim is paid out. This money, held by the insurance company in the interim, is what Buffett calls the float. This is not a theoretical concept. We have the data. In 1967, the float stood at a modest $16 million. Today, that figure has exploded to over $147 billion. This is not a liability waiting to be paid. It is a long-term, interest-free capital pool. While other investors or hedge funds must pay hefty interest rates on margin loans, Buffett gets to deploy a massive war chest that essentially costs him nothing. It is a financial cheat code that no retail investor can access. This float allows him to sit patiently and wait for the perfect moment of crisis. When opportunity knocks, he doesn't need to call a bank or worry about maturity dates. He simply deploys capital from the float. This is the primary engine of his outperformance, the source of his infinite patience, and the reason he has a structural advantage over every money manager on Earth. But even $147 billion is useless if you don't control the destination. Buffett ensures absolute stability by being more than just an investor. He is, first and foremost, the supreme owner and operator of entire industries. You see headlines about Apple and Bank of America, but the real money, the stable, boring, dependable money, comes from the companies he owns outright. Berkshire Hathaway is not a portfolio. It is a conglomerate of over 60 wholly owned subsidiaries. This is a critical distinction. Stock market investments, the public holdings, are subject to quarterly volatility and external pressures. The private holdings, however, are stable, cash-generating fortresses. Consider BNSF Railway. In 2010, Buffett acquired this massive, capital-intensive infrastructure company for $44 billion. This wasn't a stock purchase. It was the acquisition of a near monopoly on vital transportation infrastructure. Railways are recession-resistant, regulated, and act as a near-perfect hedge against inflation. They throw off vast amounts of predictable cash that constantly feeds the central Berkshire Hathaway machine. He is not trying to find the next great growth stock. He is buying the indispensable backbone of the American economy. He is a capital allocator who prefers ownership to speculation. This stability guarantees that the $147 billion float is constantly being regenerated and put to work, creating a self-sustaining financial cycle. But to truly understand the legend, we must move past the numbers and look at the rarest commodity of all, the psychological discipline that allows him to execute these moves when the rest of the financial world is literally collapsing. This is the ultimate, final secret, and the proof of his unparalleled genius. The behavioral edge. In the depths of the 2008 financial crisis, when the global economy was staring into the abyss, what did Buffett do? Did he panic? No. He deployed capital aggressively, most famously acquiring preferred stock in Goldman Sachs. He was buying the highest quality assets when the price was cheapest because fear had taken over. His rule is vindicated by the data. Be fearful when others are greedy, and greedy when others are fearful. His success is proof that in finance, emotion is the greatest destroyer of wealth, and psychological discipline is the greatest accumulator of it. He is a machine of pure, rational self-interest. The story of Warren Buffett's billions is not about stock tips. It is about a system built on longevity, powered by the insurance float, stabilized by total ownership of essential businesses, and governed by unshakable psychological discipline. You cannot access the $147 billion float, but you can control your time and your emotions. You can adopt the psychological fortress. If you found this deconstruction valuable, ensure you subscribe now and turn on notifications. Our next deep dive will break down the exact psychological principles Buffett uses to avoid panic. Click the link in the description to download our free resource summarizing the 7 most common behavioral mistakes investors make in a crisis. Don't miss out.